Eric Nuttall of Ninepoint Partners is back with some ideas for you among oil and gas stocks. All of these three have decent dividend yields. Let's start off. Eric, great. Thanks for staying with us. Freehold royalties, a yield of not far off 8%.
Yeah, so just under 7.7%. We think it's defendable down to about $55 WTI. And my three selections are in the context of we are in a market today where sentiment is profoundly challenged, even though fundamentals are not. But the likelihood of meaningful capital coming back near term is unknown. And so why not be rewarded with a healthy dividend while retaining meaningful upside exposure to a rising oil and natural gas pricing? So Freehold has been a very large underperformer. I think Prairie Sky, its nearest competitor, has done spectacularly well, trades at roughly twice the valuation as Freehold. The CEO perhaps is just able to sell the sizzle a little bit better, but we think Freehold has about 12 years of growing stay flat oil inventory. It is a royalty co, and so they're not drilling wells. Companies will lease out their land in exchange for a royalty. So you're not taking on any exploration risk. They are benefiting from a rise in drilling in certain heavy oil plays, such as the Clearwater and Manville Stack, et cetera. So the inventory depth may be more than people believe. And as well, there is a potential negative in that Tyne, which is a private company, about 10% of their volumes, was rumored to have been a buyer of an asset package sold by Chevron. It was this big Duvernay package. And so if true, that was likely going to divert capital that they would have spent on Freehold's land to this new package. Well, we now know that C&Q bought that. That risk has been eliminated, but the stock never really recovered from some of the fear that people had on that. So you get a company that's underperformed from a stock-wise. Operationally, things are fine. You get paid almost 8%, dividend, tax effective. That's very, very defendable.
Your next idea is a famous name in natural gas, Peyto Exploration. Big yield, but they have stuck to the dividend.
Yeah, huge yield. So it's yielding 8.6%. It's very, very safe both this year and in 2025 due to very strong hedging that they put in place when they bought an asset off of Repsol. They're 62% hedged next year at $4.10. Contrast that to like $1.50 depending on the day for AECO. So very strong hedges. As we roll into 2026, we think the current dividend is sustainable down to about $2.75, which we're medium-term and long-term bulls on natural gas. Many people say that natural gas would be the bridge fuel. We think that's nonsense because we're not bridging to anything. There is no energy transition. There's only an energy expansion. And so the role of natural gas for AI and data centers and overall power demand increases, we think is a very strong medium and long-term story. We just have to get through the short-term bearishness because, as we all know, natural gas storage in Canada is very, very high. It may actually reach full levels in the next month to 2 months. Pricing could easily go negative. And these guys are well protected from that. So you get good exposure to the medium term. You get paid an 8.6% yield, which is very, very safe.
Presumably, if natural gas does bounce in price, though, Peyto will be less popular because they've hedged.
It may, but if I'm getting paid 8.6%, I'm still going to get some of the upside as well. Maybe they're not going to shoot the lights out as a super high cost, torquey, over leveraged guy, but these are the types of names I'm safe. I can sleep at night very easily with right now. And
so, Eric, you don't think humanity is going to reduce its use of oil and gas? Oil and natural gas?
I think the percentage of the mix will fall over time, but the absolute volumes will not. The demand for energy is unbelievable. Like, roughly speaking, the demand for energy grew by roughly 40 million BUEs a day. That's barrels of equivalent. So just in a barrel terms, over the past 10 years, it's going to grow by at least another 40 million over the next 10 years. And people that are much more literate than this I have no idea. They can't even fathom where all that energy is going to come from. So we need wind, we need solar, we need nuclear. Coal demand is at record highs. Coal demand is going to increase. So too will it for natural gas, and so too it will for oil.
So you don't think we're going to get off fossil fuels?
Absolutely not.
Okay. And then your final idea here, Veren Energy, the former Crescent Point.
Yeah, so Veren's been a massive underperformer. Concerns about a weak Q3, which they've been very public with. This is a name I think that got a lot of U.S. hedge funds in, and so they tend to be a little more whippier than long-only plain vanilla money up in Canada. We bought some more shares this morning, so I think we're now their largest or one of their largest shareholders. We're getting paid 5.5% dividend yield, sustainable down to 50. we're getting at least 20 years of stay-flat inventory. It's underperformed by 20% over the past 6 months, owing to these concerns about the quarter. And it's not like they're drilling weak wells. It's solely that they had third-party issues, so the facilities which they run their molecules through had downtime, so it's impacted, the quarters. I'm buying this for the next 10 years. I'm not buying it for the next 10 minutes. And so we look at a name, it's trading at 3.3 times cash flow at $70 oil, 12% free cash flow yield. If you want to use oil, where the oil price was like 2 days ago at 75, well, it's trading at a 16% free cash flow yield. And so the reasons for underperformance, we think, do not have merit. We're getting a very strong balance sheet, a management team that is ultra-conservative, exceedingly high-quality inventory. They've been drilling the most economic Montney wells ever drilled in its existence. So it's a name, again, you get paid to wait a while until sentiment improves, and when it does, we see meaningful upside.
And what would their mix be between oil and gas? Do they have a lot of gas?
Yeah, it'd be about 30-ish% gas. So it's you've got predominantly liquids exposure. The gas weighting will grow over time as they increasingly drill more Montney and more Duvernay.
Right. And does the name still have an overhang from the days it was Crescent Point, just psychologically?
Oh, yeah, it does. It was such a horrible
because the dividend was too high for too long, too much dilution.
Chronic dilution, chronic M&A, and you can see it in names this year, less so in some, but names that were active acquisitors over the past couple of years. You issue a lot of stock, it needs to be digested. Those whom you're selling the stock to, usually private equity companies, then have the stock. Will they become sellers? It creates this constant overhang. Poor performance in the stock price leads to people just not having the willingness on days like today to step in and defend a name. So, we bought $8 million, a million shares of Veren this morning. That probably took us about an hour to get filled, trying to not move the stock. In a day when things are getting slammed down 5 to 6%, we're not seeing capitulation. We're not seeing panic selling. There's been so much volatility this year. We've set so many records. Record low sentiment, record low inventories, record high demand, super volatility, geopolitics with Iran and Russia and Ukraine, all of these different things. I think energy investors are just confused. And so they turn on, the TV and they hear about the IE cutting demand and they're like, screw it, I'll just go buy more NVIDIA and call it a day.
Eric, on that note, we better leave.